Hey traders, it's Rishi, and welcome back to another episode of Investing. We discussed a fair share about the macroeconomy in the last video. The next step in the search for the right company, utilizing a top-down approach, requires us to look into sectors, industries, and then individual companies. So in this episode itself, we're going to talk about sectors and industries and how to pick the best ones to choose our stocks from. First, I want to differentiate between sectors and industries. An industry is a group of companies that have similar operations and provide similar goods and services. A sector is an expansive and broad grouping of related industries, often thought of as like the umbrella category. The word sector is a more broader term to use, and it captures a larger scope of companies in comparison to the word industries. Sectors, again, can house multiple industries within them, and these industries hold hundreds and thousands of companies. So in this example here, it's pretty simplified, but you have information technology as a sector, and within it you can have IT services and semiconductors as the industries. And then again, like within semiconductors, there's multiple companies like NVIDIA. And then healthcare, same thing. You can have different industries within them like biotech and pharmaceuticals, and there are many different companies within them. Another example is consumer discretionary. Consumer discretionary is a sector. Within there, you can have hotels, restaurants, and leisure. And within there, you can have companies like McDonald's and Wendy's. Let's start with sectors. According to the Global Industry Classification Standard, in the stock market, there are 11 sectors that hold a combined 74 industries. The first sector is the information technology sector, which consists of companies distributing or developing technological items or services. Second, there's the healthcare sector. This is made up of the medical supply companies, the pharmaceutical companies, the biotech companies, and anything that aims to improve the human body or mind. Third, we have the financial sector, and these are all the companies in finance, like banks, mortgage companies, insurance companies, brokers, anything of that sort. Fourth up, we have consumer discretionary. These are the companies that provide products that are luxury items, and they aren't really necessary for survival. Fifth, we have the communication services sector, and these are the companies that are keeping people connected, like internet providers and even entertainment companies. At sixth, we have industrials, and the companies involved in this sector typically produce capital goods. Some of the companies involved in this sector include airline companies and railroad companies. We've got 5 more sectors to go. At 7, we have consumer staples, and these are the companies providing the necessities for survival, like food and beverage companies. The 8th sector is the energy sector, which consists of the companies relating to producing or supplying the energy. Some companies are also involved in development of gas and oil reserves. Up at 9, we have the utility sector, and the companies involved in this sector generate electricity, gas, and water and provide these to the buildings and households. The 10th sector is the real estate sector, and the companies involved in this sector buy, sell, and develop land, residential, and commercial properties, and also related assets. Last, at 11, we have the materials sector, and this consists of the companies providing raw materials needed for the other sectors that we mentioned above to actually run. People tend to mix up the materials and industrial sector, but remember, the material sector is for raw goods and industrial sector is for capital goods. We can categorize these sectors into 2 different categories, which are cyclical and defensive sectors. Cyclical sectors are on the volatile side and have a relatively strong correlation with the business cycle. These sectors like to follow the economic trend and outperform in the bull markets. Companies that fall in these cyclical sectors tend to sell normal and luxury goods that have an increased demand during economic growth and increases of income. However, these companies struggle to preserve their capital during weaker periods of the economy. For example, the companies falling under the cyclical sector include the information technology sector, consumer discretionary, financials, materials, industrials, and real estate. Defensive sectors are the opposite. The companies in these sectors tend to outperform the cyclicals during economic decline. The defensive sectors don't have a strong correlation with the business cycle, as the demand for the goods and services provided by the companies in these sectors remains steady. These goods and services are typically consumer necessities and used in daily activity. This results in lower fluctuation, providing a sense of protection for the investors of the stocks in these sectors. In periods of economic growth, however, the companies don't tend to outperform like the cyclicals do. The sectors involved in the defensive category include consumer staples, healthcare, energy, utilities, and communication services. Again, some sectors are stronger than others in different periods of the economic or market cycle. Here, we can see that the effects on the market occur before the effects on the economy, because the market tends to predict the state of the economy 3 to 6 months in the future. Here, we can see that all the cyclical sectors are the ones that seem to be outperforming during the bull markets and economic growth. However, in times of decline, these cyclical sectors don't tend to perform very well, which is why people switch to the defensive sectors, which provide a higher rate of return during these times of economic and market decline, which is why the consumer staples sector comes out and outperforms. If we go on the Select Sector SPDR ETF's website, the sector tracker shows us that over the 6-month period, technology has been doing absolutely phenomenal. Some of the companies in this sector have increased by over 50%. Nvidia was doing absolutely amazing after its Q2 earnings came out, and other companies include Adobe and Broadcom and Arista. Stocks usually move together in their sectors, and we can see that right here. If I click this next button, we can see that a lot of these companies have been having similar increases in price, as the percent change has been relatively high for the technology sector. Again, it's always important to remember that usually the market runs on a team. So always try to pick out these strong stocks that come out of these good sectors. For example, if we had a really strong stock in a bad sector and then a mildly well stock in a booming sector, you would always want to choose that mild stock. Never take the risk with bad sectors. And before we end off for the sectors portion, I just wanted to note that if you would like to invest and get exposure to all the stocks in a specific sector, it can be done through SPDR sector funds. Now, I want to move to industries and talk about that pretty briefly. Again, I just want to reiterate, an industry is a group of companies that undertake similar business ventures. These industries can be categorized together under a specific sector. Oftentimes, people are unable to differentiate between different industries and feel like there isn't a clear line that separates them. The solution to this issue is the North American Industry Classification System. These codes are used to classify firms into specific industries. The numbers used in the classification actually have a meaning as well. The first 2 digits represent the sector, the third digit represents a subsector, the fourth digit represents the industry group, the fifth digit represents the industry, and the sixth digit represents the national industry, as this includes Canada, Mexico, and the United States. Using these classifications are extremely important in industry analysis, as we can define exactly what industry we would like to target with our investments. The industry life cycle is the final aspect of industries I want to cover in this episode. Many tech industries show many large investment opportunities due to the breakthroughs that are currently occurring in artificial intelligence. New chatbots and smarter AI cause software companies to have high sales for their AI products. These companies are rapidly growing. However, this growing interest cannot last forever. Eventually, more competition will enter the market for software applications. Lower profit margins will result, and growth will be slower or even fall in the future. This idea is encapsulated by the industry life cycle. These early stages for industries are often distinguished by new products or services. This causes the rapid growth to occur in the beginning. Following this, we have a consolidation period. Here, after the product is established, industry leaders begin to emerge, which means that more competition is prevalent. Now, we see more of a stable growth. After a longer period of time and more innovation on this product, it may peak or reach its potential use. We call this the maturity period. And now, producers are mainly just competing on price. The final stage is the decline stage. Many of the companies that are selling this specific product may leave the industry due to the product being outdated or just evolving markets. The life of this industry is now over. That's the end of today's episode. In the next episode, we'll be covering how to strategically pick these individual companies that are the best performing in different sectors and industries. If you're celebrating Diwali, then happy Diwali, and if I don't see you until Thanksgiving, then happy Thanksgiving as well. Make sure to like and subscribe to my channel, and share this video to spread the knowledge. Thank you so much.